About a month after the initial coronavirus outbreak, Mohamed El-Erian told us that he would advise resisting the temptation to buy the initial coronavirus dip. That was back on February 3rd.
The coronavirus is different. It is big. It's going to paralyze China. It's going to cascade throughout the global economy. And importantly, it cannot be countered, as Michel just noted, by central bank policies. So I think we should pay more attention to this, and we should try and resist our inclination to buy the dip.
Joining us now on the Squawk Newsline is Mohamed El-Erian, Allianz chief economic advisor. And Mohamed, reflecting back on those comments, they were prescient at the time. There's still a lot we don't know about this virus. What would you tell people at this point in terms of the stock market?
I would say continue to resist, as hard as that is, to simply buy the dip because it has worked in the past. As you say, Becky, there are uncertainties. There are three uncertainties. One is the short-term uncertainties. How quickly can we contain this virus? How quickly can we reverse the economic effects? Second, the longer-term uncertainty. What does it do to China's development process? What does it do to the process of deglobalization? And finally, there's a whole host of uncertainties related to initial conditions. The global economy wasn't in a great place to begin with, and markets had been decoupled in terms of valuations from fundamentals. So I think there's a lot of uncertainties out there. I understand the inclination to buy on the dip. I understand that the path of least resistance for this market is to bounce up, because that's what it's been conditioned to do. But I stress, this is different.
Everything comes down to price, though, correct, Mohamed? I mean, I would assume there would be some point when you would say it's okay to buy on the dip. Is that a 10% pullback, 15% pullback? Is there a point where you say, oh, okay, there has to be some value here, and now we've reached panic levels?
Yes, of course. I mean, valuations matter a great deal. Remember, the consensus recommendation was not only buy on the dip, but buy the markets that have lagged, buy emerging markets. So let's look what has happened. Since the highs, we are in the U.S., we are 5%. Emerging markets are up 10%. So yes, there'll come a time not only to buy the dip, but there'll come a time to buy the markets that have lagged, just not at these valuations yet.
Mohamed, these are such difficult things to track. You're an incredible economist, but we're all trying to figure out now what the epidemiology is of this virus, what countries are doing behind the scenes, what the political implications are. How do you try and sum this up, or do you just stay out of it and say it's too complicated right now?
No, I do a lot of research. I talk to lots of people. The medical profession will caution you, will tell you we don't quite understand this virus yet. There's lots of uncertainties. I look at the economics. We're having this cascading economic stop. Ask Joe, will he go on holiday to Italy again now? No, he's going to wait. So we're going to have a lot of risk aversion on the part of economic actors. It's going to take time, Becky. So yes, there's so many uncertainties. And what you've got to do is collect data and try to put a picture together. And that picture is very murky right now.
The World Health Organization, is still saying that right now this is not a pandemic. But when you have outbreaks that we're watching in Italy, in Iran, in South Korea, and now the threat level in Korea has been raised to red, what does that mean? Do you think there should be a situation where we are shutting down travel between countries?
And that's the deglobalization question. And that question is out there. The U.S. issued a travel alert on Korea today. So, people are thinking about this. It is a deglobalization shock. And unlike a financial sudden stop, economic sudden stops are hard to restart. I've seen it because I worked on small developing countries where these things happen. They don't tend to happen in the second largest economy in the world. So this is consequential, and we're going to learn a lot. I would just caution, there's so much uncertainty right now that if you're going to buy this dip, make sure you focus on companies with very strong balance sheets, a business model that's robust enough to a global recession, and the agility to move quickly. There are companies that are going to make sense, that are going to get hit like others, but don't deserve to be hit. But it's a very selective game. It's not going out and buying the indices, and especially not the indices in the more vulnerable economies.
Mohamed, when you look forward, what are some of the things you're looking for as indications that things are stabilizing or going to get better? Well, what are a couple of things that we should look for that we haven't seen yet?
So first, understanding of what exactly is this virus and how do you contain it. We haven't gotten there yet. So basic medical information. Secondly, the confidence of people to re-engage. Look at China. The government is ordering people back to work, and we're getting 20 to 30% of the people turning up. So there's a massive risk aversion because this is unknown. The behavioral scientists will tell you that when you shock us with something that takes us out of our comfort zone, it takes time to get back to normal activity. So that's the second thing I'm going to look at. And then the third thing I'm going to look at is how much damage have we created to companies that were vulnerable. Look at the BBB credit market in particular. There's a lot of risk of fallen angels there, and that can change dynamics. So look at A, the fundamentals of the disease, 2, how quickly people regain confidence in the system, and finally the technicals.